I think Bitcoin's still in a very kind of low sentiment area. It's not getting any favors at the moment from a hawkish Fed, similar to gold. But once that starts kind of forming a bottom and a longer base, I think that's an interesting kind of 2-year trade or longer. But for a lot of investors, I think the core of a portfolio makes sense to be equities. But I think Bitcoin's fundamentals are still good, and it's kind of in the bottom, 10, 15% of its kind of historical. There's different ways to measure value for it. For example, market cap compared to on-chain cost basis and things like that. Other sentiment indicators. It's kind of near the lower end of a lot of its historical indicators.
The Middle East tensions eased, markets celebrated, and Bitcoin surged, a glimpse of what this asset is truly capable of when fear steps aside. But then the Federal Reserve struck a hawkish tone on interest rates, and traders pulled back, sending BTC toward key support near $64,000. On the surface, it looks like a setback, but dig deeper, and a very different picture emerges, one that seasoned analysts are calling a generational buying opportunity. Lyn Alden, one of the most respected macro analysts in the industry, is watching Bitcoin closely, and she likes what she sees beneath the noise. Yes, sentiment is low right now. Yes, the Fed's aggressive stance is creating headwinds, just as it does for gold and other hard assets. But Alden sees this not as a warning sign, but rather as a setup. She believes that once Bitcoin forms a bottom and builds a longer-term base, it becomes one of the most attractive investment opportunities available on a 2-year or longer horizon. More importantly, she points out that Bitcoin is currently trading near the bottom 10 to 15% of its entire historical valuation range, based on market cap relative to on-chain cost basis. In simple terms, Bitcoin is historically cheap right now. So why is it this cheap? Alden explains two forces have compressed Bitcoin's price. First, broader crypto weakness is dragging Bitcoin down. Sectors like DeFi, NFTs, and ICOs have largely stagnated since 2021, and their underperformance has unfairly weighed on Bitcoin, an asset with fundamentally different and far stronger foundations. Second, capital has rotated into AI. Many investors have shifted money away from crypto and into AI-related plays such as chip stocks and hyperscalers, creating temporary selling pressure on Bitcoin. The weakness, in other words, is external, not structural. The data backs this up. According to Hawkish Finance, Bitwise analysts confirmed on June 20 that Bitcoin's valuation metrics place it firmly in historically undervalued territory. The most telling signal is that the Bitcoin Mayer multiple has fallen below 1.0, a level that has historically marked the beginning of major long-term accumulation phases. If you found this video informative, don't forget to like, subscribe, and share it with others. Thanks for watching.
I think basically I think there's two big factors. One is that the broader crypto space, which I'm pretty structurally bearish on outside of Bitcoin and stablecoins. I think it's finally just seen throughout the market that that narrative doesn't have as much legs as people thought it did. A lot of it was kind of fake decentralization. A lot of it was regulatory arbitrage, and that there's really not a lot of there outside of hard money. Stable coins, tokenized gold, tokenized equities. I mean, real world assets, that's still fine. But generally these other crypto things, DeFi, NFTs, ICOs, that kind of thing, is just in general, it's not as big of a market as people thought. So I think that industry is kind of gradually stagnating. It really has been stagnating since 2021. Like DeFi total locked value never really took out its 2021 peak, for example. So I think that Bitcoin has that whole kind of broader thing weighing down on it. And then obviously there's been concerns around some of these levered Bitcoin treasury companies, which sometimes I think are overdone, but some of those are valid concerns. I mean, anytime you have leverage, I think it is worth paying attention to, how they're managing risk. And then the other factor is that a lot of investors that kind of viewed Bitcoin or broadly crypto as the fastest horse in the race have shifted toward AI. So just the sharp rise in chip stocks, in hyperscalers, obviously the SpaceX IPO, that's pulled a lot of capital that is otherwise, maybe seeking, kind of viewing Bitcoin and crypto as tech has been pulled in that direction. So until that kind of cools off a little bit, I think Bitcoin could be some pressured. But I think Bitcoin's fundamentals are still good, and it's kind of in the bottom, 10, 15% of its kind of historical. There's different ways to measure value for it. For example, market cap compared to on-chain cost basis and things like that. Other sentiment indicators. It's kind of near the lower end of a lot of its historical indicators. I have a strategic allocation, which is just high quality equities, basically equities that are not in a bubble, growth at a reasonable price, sometimes value. I think gold obviously took a hit. Whenever you have the market perceive that the Fed's going to be a little bit more hawkish, you generally get a little bit of a sell-off in gold. The issue there is that gold had a really, really powerful 2-year run. So I do think that it has to like build a new base. Like, some bears would say gold's going to round trip all of its gains from 2024, 2025. I wouldn't be in that camp. But it did rise really quickly. A lot of the asymmetry was taken out of the trade. And I think it has to kind of find a bottom and build a new base. So I'm not jumping into gold as a trade, even though you still have like just a permanent strategic position in it. So for me, a lot of the interest right now is in equities. I think Bitcoin's still in a very kind of low sentiment area. It's not getting any favors at the moment from a hawkish Fed, similar to gold. But once that starts kind of forming a bottom and a longer base, I think that's an interesting kind of 2-year trade or longer. But for a lot of investors, I think the core of a portfolio makes sense to be equities.
Lyn Alden explains that the rotation away from crypto is not just happening within the crypto sector itself, it is a much broader shift across multiple pools of investment capital. Many investors who were deeply enthusiastic about digital assets throughout the 2010s and early 2020s are now moving toward artificial intelligence, viewing it as a newer and more productive frontier for both building and investing. The numbers tell the full story. US spot Bitcoin ETFs recorded approximately $2.7 billion in outflows in just 1 week ending June 5, 2026, pushing year-to-date net outflows past $3.1 billion. Over that same period, AI and semiconductor stocks surged roughly 170%, while the AI UBS Winners Index climbed nearly 50% in 2026 alone, compared to just 3.5% for the broader S&P 500 excluding AI names. But while everyone is chasing AI, something equally important is happening on the macro side. Lyn Alden points out that bond markets are driven by inflation expectations, supply and demand dynamics, and global capital flows including geopolitical factors. She was structurally bearish on bonds from 2019 until recently, expecting either rising yields or weak real returns relative to monetary debasement. Today she views bonds as a neutral and unimpressive asset and deliberately avoids trying to time short-term interest rate movements. One of the smartest macro minds in the room is simply not finding opportunity in bonds right now. Let's get back to the interview.
Obviously AI is sucked in a lot of pools of capital. I think that it's not like just the crypto space went
Hmm.
into AI. It's like a lot of pools of capital went into AI, and
Yeah.
I would say yeah, a lot of investors that were excited by digital assets throughout the 2010s and early 2020s there's a new set of tools to either build on or invest in. So I do, yeah, a lot of it has kind of rotated in that direction, which I think is healthy because again, I think the broader crypto space, I just think there's limits there to what it can do. There's obviously expectations around what inflation is going to be. There's sheer amounts of supply hitting the market compared to what is that existing balance sheets are willing to buy. There's even geopolitical decisions sometimes, like are international buyers on strike or are they accumulating? Um, and for from 2019 until a year or two ago, I was kind of on the record of being a pretty structural bond bear, meaning that either combination of higher yields, meaning bond prices down, or even just sideways yield and not really keeping up with debasement. Um, but once we got to like a year or two ago, I view them more as kind of a neutral, unimpressive trade, which is that I don't try to anticipate, 50 basis points moves in either direction for the long end. I mean, in general, if the market expects that the Fed's going to be a little bit more hawkish than they did a week ago, it makes sense that we've seen some curve flattening, which is that, of course, they're a little bit more hawkish on the short end, and they're a little bit more comfortable with the long end. But these things can change very quickly. And I think one of the key factors that I think the market still doesn't fully appreciate, because the market is so trained to think that the solution to inflation is always higher rates. That's kind of the main lesson from the 70s, or at least like that's the biggest takeaway from the 70s, early 80s. Um, and but that was in an era where most of that money creation was from bank lending. And interest rates are a very powerful tool for curtailing or and sometimes accelerating bank lending. But when you're in fiscal dominance, when fiscal deficits in a given year are bigger than net new bank loan creation, interest rates don't do quite as much for that because every time they raise interest rates, while they could put some downward pressure on bank lending, they actually blow out the fiscal deficit even more. Um, and so they're in a it's a challenging position to be in if you're the Fed, because as the chairman pointed out, their current levels are already restrictive on housing, and yet we still have above target inflation, and it's not, it's because it's not really bank lending.
Bitcoin remains a key long-term asset in the current market environment, and for patient investors, the short-term pressure it faces from shifting liquidity conditions and changing sentiment may be exactly the opportunity worth watching. Equities continue to serve as the core foundation of most portfolios, while AI has emerged as a major destination for global capital, fundamentally reshaping investment flows. And yet, amid all this noise, one thing stands clear: the broader crypto sector outside Bitcoin is showing structural weakness, while Bitcoin itself continues to hold its ground as a serious long-term store of value. Is Bitcoin benefiting or suffering from the rise of AI as an investment theme? Share your thoughts in the comments. If you find this content useful, please support our channel by liking, subscribing, and sharing. As a new channel, your support means a lot to us and helps us grow.